Everybody, Adam Taggart, co-founder of peakprosperity.com, back for another week of trying to make sense of these markets with the lead partners from New Harbor Financial, the financial advisory firm endorsed by peakprosperity.com. As always, I'm joined by the two lead partners, John Lodra. Hey, John.
Hey, Adam. How you doing? Great to be with you again.
Thanks. And Mike Preston.
Hey, Adam. How you doing?
I'm doing great. Last week, sort of talked about my caveman hairdo, not having gotten a haircut for 3 months or so. Just got one yesterday, feeling very streamlined.
Looking good.
Thanks.
We won't tell you it's crooked, but that's all right.
All right. So let's get started right away with what is new from last week in the markets. We've been talking for weeks on this sort of building resurgence of ridiculous asset price bubble in the markets. It's been a ferocious V-shaped recovery. I think the strongest down, the quickest down in history, and also the quickest recovery in history. So, in terms of what's happened over the past 7 days, Mike, why don't we start with you, and then John, you chime right on in. But what has caught your attention, if anything, in the markets since we met last week?
Well, the markets just continue the V-shaped recovery, like you said. We still think it's a bear market rally, but we're noticing euphoria and bullishness everywhere. We don't purport to know the future for sure, but what we do know are valuations and technicals. Valuations are exceedingly high, and if you take into account the fact that S&P earnings are sliding, they continue to slide. Valuations are probably higher right now at the S&P of 3,040 than they were probably at the February 19th high. So on the week last week, the market was up a little over 3%, 3.2%. It's Thursday afternoon right now, May 28th, I guess, and we're up about 3% on this week, on top of the gains last week. So, we're closing in on a 70% retracement on the S&P. Historically, a very deep retracement. The news media, the financial news media is saying, we're back to normal. That was just a blip. A lot of people we're talking to are hearing that from their advisors. We're still saying caution is warranted. It's hard because at this point in the bounce, in the cycle, people start to get really emotional. I'm noticing it in the people I'm talking to. They're getting emotional if they got out in March. They're feeling like they missed out. They're kicking themselves. And other people are feeling overconfident, frankly, sometimes. If they didn't get out, they're feeling overconfident, saying, well, this is the right thing overall. That's why these bounces, these second wave bounces, are very dangerous. They make you feel like there's no risk, and we think it's to the contrary.
All right, John.
I'll just add to that, Adam. So to Mike's point about the emotions, they go the full gamut. Mike spoke of a couple there: regret for selling, feeling confident that, hey, thank God I didn't panic. I'm talking to and working with a lot of people who are thankful they've had this chance to do what they should have done in their minds back in March, recognizing that the economy was in a much precarious state even before this coronavirus came on, and certainly financial markets were. So, just in the last couple of days, I've had folks really want to liquidate some very large portfolios, even, very happy to pay, pretty substantial capital gains taxes as a relatively small price to pay to, get in a much more defensive way, and recognizing that paying taxes isn't the boogeyman. It's actually the great thing you get to do once you actually realize some gains that otherwise could be at risk of being, quickly. So the emotions are pretty rampant in all different ways, to be honest.
Yeah, two things on there. One is the job of every bull market rally or every rally, bull or bear market, is to try to sucker in the last sucker, right? And that's what happens here is you get tested as that fear of missing out, that fear of easy gains, seeing everybody else make the easy money, or in this case, just feeling like the Fed is just in complete control. It gets real hard for people to hold on. And the one thing I like to refer people back to is we've written at this on Peak Prosperity a couple times, but if you look at the research, emotionally, we feel the pain of a loss 2 times as much as we feel the benefit of a gain. And people always forget that. when the greed phase kicks in and overwhelms the fear phase. But if you can just remember how things felt 2.5 months ago, and how for the people that were fully long and were suddenly down over 30% in their portfolios, it just felt horrible. And I always encourage people to kind of reflect back to remember what that felt like, because it's easy to forget about it and get real excited about the easy money. But man, if that bear market rally fails and you drop again, the pain you're going to feel from not selling or getting defensive when you had a chance will far outweigh the benefits of getting a few more nickels in front of the steamroller. All right, John, so before we hopped on the video here, you had sent over a couple of charts that I think speak to just quantitatively, given where valuations are today, the types of returns that investors can expect from here. Should we pull those charts up?
To talk about these two charts, they do work in tandem, and they put an exclamation point on a couple of things we just touched upon there. So for the first chart here, it's a scatter plot. It shows, over a wide range of history, a relationship or perhaps even a lack thereof of valuation levels, price to earnings ratios, and the 1-year subsequent returns in the stock market. Okay. And what you see here is a scatter plot that's pretty scattered, right? So when you're looking at a scatter plot that's pretty scattered, it's pretty, in a picture, it's indicative of, well, there isn't a very tight relationship over this particular time frame. So that speaks to the psychological torture that late stage markets dish out. Because the truth is, even though valuations are very extreme, it doesn't mean markets can't go higher for a short period of time. And it's just a classic bubble getting bigger kind of thing. And ironically, it kind of leads to the mantra that you can't time the markets. Markets can go up and go down. It's a futile effort to try and time them. But if we talk about the next chart, which actually looks at the relationship between valuations and returns over the following 10 years, you see a much tighter scatter plot, meaning that there is quite a defined and tight relationship. And what you see here is current valuations, which is shown on the x-axis by the vertical blue line. At current valuations, whenever we've been at these levels or higher, and this is just one way of looking at valuations, it would be reasonable to expect from historical experience to have literally a 0% return over the next decade. So the irony here is that first chart, you don't know if it's going to be up or down, gives for the mantra, buy and hold, you can't time the market. Yet the second chart, which is really, a picture of buy and hold over the next 10 years, shows that there's a very tight relationship, and the results or the expected returns from these valuation levels are likely to be downright ugly, disappointing, 0% returns over the next decade. Some measures even suggest negative returns. So this really feeds to the psychological torture that folks feel at late stages of a market.
All right, and Hussman has very similar charts, and when we've talked to John about them, he has said, yes, we anticipate the 10-year return is 0%, or I think his latest numbers are, you said, a little bit on the negative side. But he says it's not just a flat 0% for 10 years, right? And so there may be times during that 10-year period where you could be down 50% or so. And of course, there are many ways you could get shaken out along the way. So, as an investor, when you're looking at buying in or holding at these levels, I think the point these charts make is there's not really an awful lot of upside, and there could definitely be some big periods of downside through there. So, all right, we've talked about this for weeks and weeks, but it sounds like you guys are sort of still in the camp of, hey, the downside risk at these valuations just far outweighs the allure and potential upside of betting on the rally continuing for a lot longer. And so you guys are maintaining a defensive position. I assume I'm stating the truth here?
Yes, absolutely the truth, Adam. I know it sounds boring week after week, but as long as this counter trend bounce continues, absent any major changes in other data, it's psychologically difficult for folks, for our clients, and even for us as money managers is difficult. But it's important that we maintain the discipline because we literally think there's going to be better chances, better opportunities. You know, much like we did add some positions in March, we think that there'll be some other opportunities shortly. Timing isn't possible, but we think it'll be soon.
Well, it's a big reason why we really value working with you guys is, you know, you keep your nose to the data, right? You try to take the emotion out of it. You're not there getting whipsawed with the fear and greed, volatility in the markets. And that's what's most important in terms of guiding clients to making, you know, emotionless, data-driven decisions here. And if the data changes, presumably you guys will change your mind, just as Chris and I will. All right, so what I want to do now is I want to do a quick dial through some of the numbers that we do every week. And then I want to get to the question of, okay, given that we're at this, still in this period of, the markets just look too radioactive to touch in terms of, you know, putting money in on the long side, you know, what the heck can investors do? So hold that thought just for a moment while we dial through some of the numbers here. We'll start, as we always do, with the initial jobless claims. We're now in week 10 of the spike in initial jobless claims. And another way to say that is people getting laid off. And we're now above 40 million. So just this morning, we found out that last week, 2.1 million people filed initial jobless claims. And so, you know, it's sort of like, hey, you know, the stock market recovered quickly from its 30% drop, and now we're back near record highs. Certain parts of the market are you know, pretty much at record highs. And all I, as a regular person, got was 40 million lost jobs. You know, I lost my job. I had to stay home, got furloughed, whatever. And you know, the rich people who own all the stocks got to be made whole, basically. And that's, you know, hey, thanks, Fed. And we'll talk a little bit more about that in just a moment. But you know, the silver lining here is that the initial jobless claims are slowing. But again, over 2 million people in 1 week, that would have been, you know, that would have been a record number by itself if it weren't for the preceding 9 weeks here. So we're still in really bad territory. I've mentioned that bankruptcies tend to follow layoffs by about 3-4 months. And that makes sense. You start shedding, you know, employees and your variable costs as much as you can. But then as your fixed costs begin to drag you under, if your revenues haven't recovered, eventually you got to declare bankruptcy. And what we're seeing here in this chart is that the month of May has seen the most large U.S. bankruptcy filings since the Great Recession. So we're already beginning to see the start of that tsunami of companies declaring bankruptcy. And if you're reading the newspaper headlines, you're seeing a lot of familiar brands there. Hertz announced last week. You know, some of these are, you know, 100-year-old brands out there that are now having to declare bankruptcy. So expect those bankruptcy numbers to get a lot worse as we go into the summer. Next image I want to put up here is a tweet from Sven Henrik, who we put up some of his technical analysis over the past couple of weeks. Here he's got a chart of the Russell 2000, and he says, you know, RUT, which is the ticker symbol, up 24% since its lows of 10 days ago. That's just stupid. And folks, this is the market that we're in right now, where stock prices have recovered the vast majority of what they've lost. As we said earlier, fastest recovery of stocks in history. And of course, the Russell 2000, these are the smaller cap companies, right? These are the companies, a material number of which will probably go bankrupt over the rest of this year. These are the companies that are going to get hit the hardest when we talk about the FANG stocks that are absorbing most of the capital coming into the markets today. You know, they make up whatever it is, you know, 20% of the S&P market cap, like almost 50% of the NASDAQ market cap. We're not talking about that when we're talking about the Russell. We're talking about this, you know, the smaller companies there. These are the guys that are really feeling the pain. And yet you look at the stock action here, especially the past couple of days, you know, up 24%. It's just ridiculous, right? There's just no explanation for why that should be happening, except just wild speculation on top of the liquidity that's been getting put in there by the Federal Reserve. And showing just how crazy this is this next chart, which shows the valuation of the relative PE ratio, which is a measure of how well valued stocks are. It's never been this overvalued. PE ratio has never been this high. And if you're looking at the chart, look all the way over on the right-hand side, and you can see that thin black line just shooting the moon up to nearly 70 PE ratio, which is just insane, especially for smaller companies like this. So one more image here from our buddy Sven Henrik. He says, we are witnessing the largest asset bubble inside of a recession ever. Total market cap to GDP exceeding 140%, right into a key historic bear market rally resistance pivot as unemployment is exceeding 20%, with earnings growth falling negative 20% for the year at least. Only one word to describe that: dangerous. I think Sven is really soft pedaling it there. I think it is incredibly dangerous. And Sven in the tweet below points out that he's not the only one thinking this. Big establishment Wall Street firms like Bank of America Global Research are basically saying the same thing. Their quote here is, hoping that either fundamentals will improve at record speed or that they simply don't matter is a real risk, given markets' inability to decouple from recessions in the last 90 years. So guys, I'll close here, but the point I want to make is not only are we at the point now where guys like us who have been skeptical of the markets for years and have been bringing out all the data to prove that, are just feeling that we're at a point of insanity in the markets. But even the cheerleaders, even the big Wall Street firms are essentially, now kind of on our side of the boat, saying this just makes zero sense. So gents, done with the charts this week. The question that I want to get to is, for the folks that are listening, I think a really natural question in folks' mind are, okay, hey, you guys have convinced me. The markets are the most overvalued they've ever been. Yep, I'm bad time to go long. Don't want to put my money at risk by going long. But maybe I might want to put some of my money at risk going short. If we're at such an extreme, wow, isn't now a good time to put some money in on the short side? And so I'd like to get you guys to give your honest answer to that question. But in doing so, if you can address this point, which is, when you're in a market melt up, it can last a lot longer than you think. And certainly people that went short a month ago, 2 months ago, that thought that the V rebound had been excessive at that point, have been losing a lot of money ever since. So talk about the timing of going short and talk about the risks of being short in this type of market. John, why don't we start with you?
Yeah, so there's plenty of data, plenty of fundamental justification for being inclined to want to play the downside of this market by going short. Look, we've also pointed out very clearly that there's forces at work here that are distorting even the most rock solid fundamental metrics that we can go back and measure, many decades, even a century or more. We absolutely don't believe that these distortive forces, let's talk about the Federal Reserve and monetary policy. We don't think they've changed the ultimate outcome. We think they've distorted things to an even greater level, which just, I think, unfortunately means a much nastier outcome at the other side of this than had to be the case, is the way I put that. Even though there's a rock solid case to be made for shorting, it's not without its own risk. It's it gets back to the psychological. People hate to lose money when the market's going up, and that's by definition. If you're wrong, if you're early or wrong on timing of being short, that's exactly what happens. You lose money when the market's going up, and that's for most people a very hard thing, even if it's ultimately going to turn in your favor. But there's also mechanics. The vehicles through which you can short. There's ways to use options, but there you have this is certainly not the format to get into all the nuances of options. But you have a lot of different factors you got to contend with. You got to be right on timing because there's a defined period that options last. There's also time decay that works against you if you're not right on the timing. Option premiums right now are pretty expensive, even with the pullback in volatility, so it's not necessarily the best way to go. On the other hand, using some inverse funds, especially levered ones, can be very sloppy in that they have a lot of tracking error, that even though you might be right on the ultimate call, due to the to's and fro's and ups and downs, the ultimate investment may not track very closely at all the directional trade you were trying to make. Now, we sometimes and oftentimes do use the non-levered one-times inverse ETFs. Those have far less issues with tracking, but they're not immune from that. They still can have some tracking error. So there's that factor. Of course, one can short outright stocks. You can't do that in an IRA. You need a margin account to do that. And there, it's like, one of the problems with shorting stocks or broad baskets of stocks is that when the market moves against you, that position becomes bigger. So the more it moves against you, the bigger that problem becomes for you if you don't have risk controls. So there's a lot of, landmines, I think, that even though a very thoughtful juncture is upon us, where taking some short exposure can be very appropriate, so long as you bound and manage the risk and understand how these positions work in both, scenarios of the market moving in the direction you anticipate and it also moving against you.
Okay. All right. Switching gears here for a sec, Mike, and we'll pivot to you for this. We just saw the data that's, showed that the markets are back to just, ridiculous levels of overvaluation. In past updates that we've done in previous weeks, we've talked a lot about the liquidity that's being pumped into the markets by the Fed, et cetera. I don't want to rehash all of that, but I do just want to take a moment to get your guys' thoughts on the more that Chris and I are looking at what's going on in the markets today, the more it really, I think, is shining a bright light on the bifurcated economy and society that is developing here in America, but in a number of other countries as well. The wealth is concentrating so quickly and at such high levels into the hands of fewer and fewer people. And it's the already rich, it's the elites, it's the folks that own the vast majority of the stocks that are out there and the financial assets that are out there anyways. And so as the markets are being not only rescued here by the central planners, but really, being heavily lavished upon. All that's happening is it's just, we had a really horrific and very concerning wealth gap before coronavirus. But now, given what's going on, we've had all those people lose their jobs. There's 40+ million people that we know of lose their jobs, meaning there's probably many more. Many more people are going to lose their jobs with those bankruptcies that are coming ahead of us. And yet, the wealthy that own assets, those asset prices are pretty much, back to the crazy highs they were at before the coronavirus came into being. And maybe they're going to continue going higher from here, right? So it's toxic to, social equity. Right. But I think it's also becoming so visible, I guess, is really where I'm going with this. I think it's getting harder and harder for the average person not to see that the well-off are getting made really well off here at the expense of everybody else. I don't know exactly where I expect you to go with that, but do you guys see through a similar lens here? And and as financial advisors, I imagine, your job is to, okay, well, we want to help people who aren't worth, $200 million, preserve and grow the wealth they have, so that they're at least not getting completely priced out of this game. That'd be my guess. But anyways, let you guys opine on this. So Mike, let's start with you.
Well, I think you might have just thrown me a hot potato, Adam, with that one. It's true. Wealth inequality was at extreme levels, before coronavirus. That's what these policies, these central banking policies do. They support asset prices. Asset prices have to go up. They have to go up and up and up forever. Otherwise, the rapidly expanding, exponentially expanding debt bubble collapses. The problem is you're taking away price discovery. You're taking away disincentives for bad behavior. We're not letting anything fail anymore. And so therefore, we're letting marginal businesses survive, and by extension, probably bad and marginal business decisions. That comes at a cost, in our view, to society and to the economy. In other words, good, well-run, prudent companies get a smaller profit or a smaller share of customers than they might otherwise get because they have to compete with zombie companies. It's just one of many examples. Another example is the volatility that we saw in March. A lot of people were shaken out of the market. A lot of good people were shaken, probably sold at the low. Now we think those lows will be exceeded and the market will move much lower over time. But in general, when you have volatility like that, then the old adage, weak hands, though I don't think in this case they're weak hands, you're basically shaking out common holders, and those shares are then getting consolidated, hedge funds and big banks and that kind of thing. So in other words, closer to the money trough you are, the more access you're getting to it. So we think it's not a good thing, not a good trend, and frankly we're somewhat distressed, even disgusted by the whole thing, to be honest, because we can see the data. We know that it's going to end badly. We don't know the timing. And the whole thing is it becomes like a psychological war game, basically trying to create psychological dysfunction or discomfort in people to try to get them, to incent them or compel them to make a decision to be in risk. And, that's probably one of the biggest values that we can give right now is that kind of emotional resilience.
Good. And that's the segue I was looking for here. And as I'm making it, I'm just going to bring up this another tweet by Michael Linden here, who I think really captures sort of what I was trying to get at with my question, where he puts up a chart here of the S&P 500, showing that it had recovered, closed above or punched above 3,000 for the first time since March 5th. And his comment on that, given all the economic destruction that's gone on since then, it says the stock market is not a good indicator of the real economy. It's more like a mood ring for rich people. I think it's very well said. So I know you guys are helping people, as you said, Mike, to be emotionally resilient, to not make irrational decisions at this point for fear of missing out or whatnot. And I know that you guys are, dealing with people who are being impacted in real time by the economic fallout from the pandemic. Whether it's they're furloughed or laid off, or their company went bankrupt or whatever. So if you guys, just in closing here, if you guys can tell us some of the conversations you're having with folks around that, I believe, and correct me or add to this if I'm not correct here. But you're getting questions from people who have lost their jobs, and so they have a 401k from their former employer, and they need help with rolling it over. Basically, what do I do with that 401k now? And I know that there are some CARES Act provisions that you guys are well aware of, and other people aren't, and so you're able to help provide some advice and guidance on that. So, John, maybe if you could just sort of tell us some of the conversations that you guys are having with people who are calling with those types of needs.
Yeah, nuanced, kind of details on the 401k and the retirement accounts, rules in the CARES Act. And this is really for folks who maybe are out of a job and really struggle. They need access to emergency funds, and for many folks, their savings are largely in retirement accounts. So the CARES Act, greatly relaxed a couple of key points. So typically, retirement accounts aren't accessible for folks between under age 59 and a half without incurring a 10% early withdrawal penalty. There are some certain provisions in the CARE Act that, broadly speaking, if you've been affected by coronavirus, there's some fine print here. And I'd say actually some kind of loosey-goosey teeth as to what defines being affected by the CARES Act. You're able to take money from your retirement accounts without the 10% early withdrawal penalty. You'll still have to pay taxes on any distributions because those are pre-tax dollars. But it can be helpful to unlock emergency funds that otherwise might not be available for a family or an individual that's struggling because they've lost their job or whatever. Also with the 401ks, the ability to borrow from them has been greatly increased. The limits have been greatly relaxed. So just really important for folks to know that if you are struggling, there are things available that you may not be aware of to make things a bit easier for you.
All right, great. And so I hope people who are watching who might be, have been affected, who have needs or questions that are relevant to what you were just talking about, John. I hope they're talking to a professional like you guys. And obviously, if they don't have a good one themselves, they should just pick up the phone and call you.
I want to make just one quick comment on the kind of rich versus poor. I think the unfortunate reality is that these policies that have destructive near and long-term effects on wealth and income inequality unnecessarily create a chasm between perceived classes when there really isn't that. I mean, these are good people. Maybe they happen to have different means, incomes, assets, but it's not like there's this class of rich and poor. But unfortunately, the policies, pit folks against each other without even knowing what they're pitting themselves against. We have the fortune of working with a lot of people from a lot of different walks of life, different income and asset levels. And, we don't see the inherent differences of what's going on in the world. They all care about the world. They care about being good stewards of the assets they have mostly worked hard to achieve. They care about leaving the world a better place than they hopefully did. So they care about things like unsustainable debt levels to fuel these kinds of stimulus programs that seem to have a black hole, a dead end at the end of the rainbow, so to speak. The mantra, oh, we'll just grow out of this debt. If you look back and look at charts of debt to GDP going back to the 80s, it's been nothing but a pretty much straight line higher. So when is this mantra of we'll grow out of the debt really going to happen? So yeah, the young people of this world are getting, should be getting pissed off, if I could use those words, because they're being, handed, higher home prices. They're being handed all these asset prices that have been inflated, maybe an economy that is sputtering and likely to get in real tough shape. And, they're going to be paying the debt that we're racking up now. It's just that those are the kinds of things that, unfortunately, create a real hole that we can't dig out of. And unfortunately, it creates more social distress than is really warranted, because we're all kind of on the same page, most of us. It's not like there's this elite class that is pervasive that's looking to squish the little guy. That's not how the world works from our standpoint. Certainly there is policies that are undertaken by the Federal Reserve that bail out investors, for example, that don't really do anything for Main Street. Like buying junk bonds in the secondary market does nothing for jobs in that company that they're buying the bonds. It saves the investors. So I'm sorry I went off on this little tangent. I'm going to let Mike, if you want to, Mike, talk about some of the pointed questions. But I just couldn't let, we need to realize it's not this fictional war, class of the, wars of the classes. It's something that these policies breed in our own minds.
All right, two quick things, and then we'll wrap this up, because as every week, we go a little bit longer than intended, but it's just because you guys have such great insights to the questions that I and our users want to ask you guys. As it regards to 401ks, I just want to see if you guys can confirm this or clarify this for me, but oftentimes a lot of companies that offer a 401k, there's a provision, and I don't know what it's called, but where you can take a portion of that 401k and give your permission to say, hey, I want to open this up. I want to treat this more like a typical brokerage account. In other words, most 401ks say, yeah, you can invest in whatever you want to invest in as long as it's one of these 6, safe funds that we've said are appropriate for our employees. There is the ability in cases, isn't there, to work with your firm and or your 401k manager to give your permission and get at least access for some percent of that portfolio to be managed or to be able to invest in other types of assets beyond just the standard funds that your employer is making available. I see you nodding, John, so why don't I let you take that?
Yeah, that's typically what's referred to as a brokerage window. So the simple concept there is, let's say your 401k plan is administered by Fidelity or Charles Schwab or some firm like that. There's usually this kind of main portal of the plan that's, the anointed lineup of funds that the company and the sponsor has chosen to be available for the participants. But then there's oftentimes what's called a brokerage window, where you can then kind of, still within the plan, go out and, pick your own funds from the broad lineup that might be available at this particular custodian, Fidelity, Schwab, or wherever. So, it's basically the universe. You are then able to access the whole universe while it's still inside the 401k plan.
Okay, great. And I just mentioned that just so people know that maybe they have more options than they realized if they've got their money stuck in a 401k with an employer. But I would say if you do take advantage of that option, I would do it again in partnership or supervision with a professional financial advisor, because your funds are they only give you a couple of sort of safe funds to in attempt to try to manage your ability to get into too much trouble. So, all right. The last point I want to make is, every week we look at the markets and we scratch our heads and say, gosh, how can they be at these crazy heights? And it's sort of like waiting for the storm to break, right? The air just gets hotter and more humid and more filled with electricity. But yet the lightning hasn't started, the rain hasn't come yet. But that's what we still expect here, is that there will be another down leg here. And if this does prove to be a true bear market rally, the second down legs historically are the larger ones and the more violent ones, right? So I'm just noticing, and I hesitate to do this because every week, we're kind of looking at whenever there is a little bit of a downward blip, the obvious question is, oh, well, was that just the top? And is this the beginning of the correction here? So who knows? But the markets closed today in rare action that we haven't seen for a while, where all the markets at some point today were green and managed in the last half hour or so to begin to roll over into the red. The Russell, notably, I think it's down over 2% at closing. So guys, before we sign off here, I'm just curious, too early to tell, let's not make anything of it, or are you seeing any action here that's kind of catching your eye at all? Mike, we'll start with you. John?
I think it's too early to tell, really. I mean, yeah, we had a late day reversal. It caused a candlestick, which is bearish in the short term. But 2 weeks ago, we had a bearish weekly engulfing pattern in the S&P. And what happened the next week? It went straight up through that and broke out to the upside. So short term, this market is not predictable at all. There's a lot of emotion, and the emotion is very charged, and it's driving this market to do crazy things. And if nothing else, it seems like this market is more intent on doing the opposite of what's usual. So we'll see. But this retracement is deep. It's historically deep. It's deeper now than the retracement that happened after the 1929 high. We're obviously are in high alert for reversal signs. And today's bar, yeah, it's a reversal sign, but we need a couple more like it to make it.
Yeah, to really have confidence. And I'm sorry for throwing that question at you and making you have to respond to one data point. But I think one thing that's notable, and this is really more on the technical side, but there's a saying in technical analysis is that gaps always get filled. And this market, as it has recovered, has, when the market dropped violently, there were some gaps that were opened as the market was correcting very hard. And notably, all of those gaps have been filled now by this time. So this market has no more gaps above it to have to fill, and it has a number of gaps beneath it that have opened up as it's made its meteoric, recovery here. So I guess the underscore there, just from a technical perspective, is you really look at this market with nervousness if you're a technical investor, because it's got all of those gaps below and none of them above. John, I'm seeing you nodding here. Anything you want to add to that?
No, pretty much nodding in agreement, both with what Mike said and what you're saying now.
Yeah. Okay. And all I wanted to underscore here is, the market sort of has the technical aspect of an elastic band that's just been stretched to its absolute maximum. There's no slack left, and there's lots and lots of room for it to connect to. And the main point just being is if indeed it does correct the way that we think it will, there's a high likelihood that it is going to be very, very fast, meaning you're not going to have a lot of a chance to react, reshuffle your portfolio around and whatnot in the interim. You're either going to be positioned defensively in advance, or you're not going to be. So right. With that, guys, I'm going to thank you again for another great discussion. Hopefully, who knows? Hopefully what we're seeing here at the end of today's market, maybe that gives us something more to talk about next week if there's some follow through on that. As always, I will make sure we overlay the information on how people can reach out to you if they want to schedule an appointment with you guys. And just a reminder to folks that are watching, especially if you're a new viewer, Peak Prosperity has been referring folks to New Harbor for the better part of a decade now, because they are one of the very few financial advisors that look at the world through a similar lens as we do, that they look at the same macro risks that we do. They're very skeptical of these markets, as I'm sure you've learned by now. They're not your typical, hey, buy and hold, the stock market will always take care of you kind of broker. So if you're looking to have a conversation with somebody that thinks like these guys do, just follow the instructions here on the screen. It's totally free, and there's no commitment to work with these guys. This is just something that we collectively as the two firms have put together as a public service over the past decade. If you end up talking to them and want to work with them, that's great. And if not, there's no expectation and no responsibility. And you can just talk to them and get great feedback from exceptional professionals that think the way that we do. And if you're viewing this, I'm assuming the way that you do as a viewer. One thing to mention, and John, you were good at reminding me about this last week, they can service U.S. clients or clients that have, U.S. assets. So in other words, that's obviously people living in the U.S., it's U.S. citizens living abroad, or people that have green cards. But if you're a foreign citizen and have no money domesticated or domiciled in the U.S., I'll let you guys correct me if I'm wrong, but given international regulations and whatnot, you guys can't work with them. All right, enough of the details. Folks, thanks for watching this week. Mike and John, look forward to doing this again with you guys next week. I know I say this, and I'll probably regret it the week it becomes true, but I hope the markets give us something more exciting to react to the next time we meet.
Hope so too, Adam.
Thanks, Adam. We'll see you next week.
All right, guys. Thanks so much.
Thanks a lot. See you later.